Tightening the taps, a macroeconomic update. Step back and watch the confusion in the heart of the US monetary system. Because while the nation remains captivated by ongoing political drama, a quiet transformation is taking place, all concealed within the corridors of the Fed. Notably, the US money supply is experiencing a sustained contraction for the first time since at least 1960, with over $1 trillion being withdrawn. These developments are signaling a shift in the fiscal landscape of a country heavily reliant on cheap debt and loose fiscal policies. Let that sink in for a moment, because we've got a few visuals you need to see to believe. Tightening the taps. A country that has loaded itself to the gills on cheap debt and loose fiscal policy is finally starting to see the tightening of the fiscal taps. But wait, there's more. Interest rate surprises. Interest rates have risen from near zero up to 5.25%. If you can believe it, this is higher than the dividend paid on most investment-grade bonds today, and more on that later. And recently, Fed Chair Powell indicated that 2 more rate hikes could be on their way. Back to this point, the US money supply is slowly contracting, and the fallout effects from that aren't something that have been seen in real time yet in this new global economy we live in. The chart below shows the US M2 money supply in green, which is composed of all the money in circulation, along with the money in checking and savings accounts, retail investments in money market funds, and term deposits under 100 grand. In blue is the velocity of that M2 money supply. The velocity of capital is a number of times $1 is spent to buy goods and services per unit of time. It's calculated as the ratio of GDP to money supply. In a sense, it represents the willingness of a citizen to spend. If velocity is increasing, more transactions are occurring between individuals. If velocity is falling, like we've seen for 25 plus years, less transactions are occurring. We can see the clear negative relationship between money supply and velocity of capital in the chart above. This is because money supply growth has outpaced GDP growth and indicates that every dollar doesn't go as far as it used to. Implications of future rate increases. Looking ahead, it's plausible that we see another 0.25 to 0.5% rate increase over the next 6 months. It takes the Fed funds rate target to 5.5 to 5.75%. The reason? The primary driver behind these potential hikes lies in the Fed's concern regarding inflation. With its preferred gauge standing at 4.4 and 4.7% reading when excluding food and energy, the previous significant interest rate adjustments aren't fully reflected in the economy yet. We've said it before, these large interest rate increases are just beginning to work their way through the system. The copper signal. Copper serves as an invaluable proxy for short-term economic expectations. The spread between immediate copper delivery and copper delivered 1 month ahead reveals a telling metric. Right now, the discount between these 2 points is the widest observed in the past 25 years. You can see from this chart, it's cheaper to buy copper for delivery right now than it is for delivery 1 month from now. And it's the biggest discount in nearly 3 decades. There are 2 possible reasons why there could be such a wide discount. First, a large amount of copper just became available. This is unlikely as mines don't just surprise the market with enormous quantities of copper with no warning. If anything, copper production is lower than expected due to political unrest in major copper nations. Recently, the only large copper mine put into production was Quebrada Blanca, located in Chile. It's a joint venture between Teck, Sumitomo, and the Chilean government. This volume has been priced into the market. Second, future copper demand is projected to be lower, and as a result, copper sellers are forced to sell their product at a discount to sell out their inventories. Diving into this further, we can look at the relationship between key global commodities, interest rates, and recessionary signals. The next chart shows 3 items. Up top, a white line showing the price of Brent crude oil, the global benchmark for physically settled crude oil. Number 2, in the middle, the US Federal Reserve target interest rate, and number 3, on the bottom, the US recession probability forecast. As you can see, as soon as the Fed started tightening, recession probability increased, and in lockstep, the price of crude oil began to fall. Copper shows a similar pattern. The next chart is the same setup, copper in white, Federal Reserve interest rate in blue, and the US recession probability in red. Again, we're seeing that the Federal Reserve increases the interest rate, the probability of a recession increases, and copper prices fall. Let's take this all and make it easy to digest. The US monetary system is going through unprecedented changes, including a sustained contraction in the money supply and rising interest rates. The decline in the velocity of capital suggests that every dollar is not going as far as before. impacting individuals' spending habits. The wide discount in copper prices indicates potential concerns about future copper demand and inventory sell-offs. As the Federal Reserve tightens its policies, recession probabilities increase, and commodity prices like crude oil and copper start to decline. It's crucial to monitor these economic shifts and adapt strategies accordingly. If you want to follow the research that we're doing and where Marin Katusa is putting his own money, join thousands of subscribers to his premium research service, Katusa's Resource Opportunities.
Subscribe to the KRO, which is the Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.